Welcome to another loan guide from VALoanRater.com. Today, we will cover the VA Hybrid ARM and why it just might be the smartest loan option available to military borrowers. My name is James Shergill, licensed government loan specialist with Flagship Financial Group. While the goal today is to give you a brief but comprehensive overview of the VA Hybrid ARM, please don't hesitate to call 877-MY-VA-HUB if you have any questions about how this flexible loan product can work for you. Despite the fact that the Hybrid ARM is one of the most versatile VA loan programs available, most of the people who contact us seem to fall into one of two categories: those who are confused by the lack of clear information available, or skeptical at the benefits suggested. Well, at VALoanRater.com, our goal isn't to sell you anything, it's simply to educate. Regarding education, a great man once said, "Things should be made as simple as possible, but not any simpler." That man? Professor Albert Einstein, who's graciously agreed to help us break down the nuts and bolts of this loan and to address the most common questions associated with it. So what is the Hybrid ARM? First and foremost, it's important to remember that this is a loan product sponsored and guaranteed by the VA. Contrary to popular belief, the VA is not a lender. Rather, the VA acts as kind of a co-signer on your behalf with a loan issued by a traditional mortgage bank like Wells Fargo, Chase, GMAC, etc., etc. These lenders offer military borrowers more favorable rates, secure loan terms, and less restrictive qualifying guidelines because the VA guarantees that they will repay the lender for a significant portion of the loss in the event that the borrower defaults on the loan. This then is perhaps one of the strongest pieces of evidence that the VA Hybrid was designed to serve the borrower's best interest. Unlike FHA borrowers who pay additional monthly premiums in order to insure their loans against default, VA loan borrowers do not have to pay an additional monthly service charge for the loan guarantee. It is a benefit offered by the VA in exchange for service. Since the VA is on the hook for the loan if you default, it really makes no sense whatsoever for the VA to sponsor or guarantee any loan that puts the veteran at a disadvantage. On the contrary, the VA is incentivized to sponsor loan programs that work to the financial advantage of the veteran. The VA Hybrid is a perfect example of this. It's called the VA Hybrid simply because it combines the advantages of fixed-rate mortgages with the advantages of adjustable-rate mortgages while limiting the disadvantages generally associated with each. For example, the VA Hybrid ARM starts out with a fixed rate period of 3, 5, and now, although more rare, 7 years. Generally, these rates are significantly lower than that of fixed rates at any given time. This allows the borrower to save substantially more money than a fixed rate option, but with minimal risk. How it limits risk of the rate adjusting can best be understood by comparing the differences between traditional non-VA adjustable rate mortgages and the VA Hybrid. To start with, non-VA ARMs almost always adjust monthly, which means that in a given year the rate will have 12 opportunities, once a month, to change, which can lead to a payment that quickly becomes unaffordable. The VA Hybrid, however, can only adjust once per year. To further highlight just how different these loans are, many non-VA ARMs have virtually no cap on how high the rates can change at each adjustment. The VA Hybrid, however, in addition to being restricted to only one adjustment per year, may adjust less but never more than 1% in any direction from the previous year's rate. This means that if you had a 5-year VA Hybrid ARM at 3%, you would enjoy 5 years fixed at 3%, and in the 6th year the worst rate you could get would be 4%, and the best rate you could get would be 2%, which would then be fixed for another 12 full months before the next possible adjustment. Lastly, most non-VA ARMs adjust their rates according to financial indexes that move quickly with the market and feature rate peaks that are historically much higher than the VA Hybrid ARM. The VA Hybrid ARM adjusts according to the comparatively stable 1-year Treasury or 1-year CMT. So just how stable is the 1-year Treasury index? Well, the following graph and table represents the monthly rate benchmarks for the 1-year Treasury from the year 2000 to the present. At first, looking at the graph seems to suggest nothing particularly helpful. That is until we realize that rates tend to move in cycles. Rates tend to be lower when the economy is sluggish and higher when the economy is doing better or is more robust. Looking at the graph, we can see that the 1-year Treasury's performance is a great example of this trend. For example, we know that entering into the year 2000 marked the peak of the dot-com boom and one of the most explosive periods of economic growth in U.S. history. Following this was the sharp economic decline brought about by the dot-com bubble bursting, the airline industry restructuring, the Enron and WorldCom scandals, as well as 9/11. As the economy stalled, rates fell sharply thereafter, encouraging growth in the housing sector and bringing about the housing boom. As the economy rebounded and plateaued through 2007, we suddenly saw a sharp drop brought about by the failure of the banking and credit markets and leading us into one of the most profound recessions in half a century. For someone considering the VA hybrid, this time frame, covering one extreme of economic prosperity to such an unprecedented slowdown as we find ourselves in now, is helpful in that it shows a range of how far the Treasury Index might go from one economic extreme to the next. What's interesting is that when we look at the table showing the monthly rate of the one-year Treasury over this same time frame, we notice that at the peak of one of the greatest economic booms in American history, remember that was right around 2000, the dot-com boom, that the highest monthly rate ever achieved was only 6.33%. That was in May of 2000, as you can see here. It also shows that the most recent month's rate shows a rate much closer to 0 than 1%. So during this 10-plus year span, moving from one economic extreme to the other, we see that the average index rate during this time frame was closer to 3% than ever 4 or 5. And while this graph and table don't necessarily tell us where rates are going to be, they at least give us an idea of how the odds of being stuck in a rate that you can't afford isn't very likely, especially when you consider hybrids may only adjust once a year and have such strict adjustment caps built into them, limiting how quickly and how much the rate can adjust. If anything, when averaged together, this data suggests a period of relative rate and payment stability, potentially even better than a fixed rate loan. Well, it looks like our confused borrower still has a few questions for Professor Einstein. Can you give an example of how this might benefit someone? I think you can handle that. And the skeptical borrower says, what makes this better than a good old-fashioned fixed rate loan? Well, Professor, let's see if you can handle that. Well, in no particular order, the money can be used to offset rental losses in case you own a property that, due to the market, you're not able to sell, but because the rental market is so competitive, the rent you're collecting on it isn't quite enough to cover the mortgage payment. Well, that basically means that if you don't have a means to make up that difference, that you're in the hole each month. Having a hybrid arm where you can kind of offset that at least means that you're not going into an economic pinch trying to make the payment. You can take the money that you save each month and simply apply it towards the principal, and the hybrid allows you that flexibility. Another advantage that the hybrid has over fixed rate loans is something I touched on earlier. Fixed rate loans are seen as more secure because they're exactly that, they're fixed rates. But what they also are fixed payments, meaning that if you have a 30-year fixed rate mortgage, not only is the rate fixed for 30 years, the payment is fixed for 30 years. So that means that whatever your payment is in the first month or the first year of the loan, you're going to be making that same payment in the 30th year of that loan. The payment never changes. Now compare that to, say, a credit card, which as you pay down the balance, the amount you have to pay each month gets smaller and smaller. Well, the interesting thing about the VA hybrid arm, and all adjustable rate mortgages for that matter, is that after the fixed rate period is over, the law says that every year, whenever the payment adjusts, that the payment has to be recalculated or reamortized based on the remaining balance. So in that way, if you had taken the savings that you'd got on a hybrid arm versus a fixed rate mortgage and applied it towards the balance, the more quickly you pay down the balance, when the loan starts to adjust, you could actually be in a situation where even if the rate were to go up, your payment could go smaller and smaller and smaller because it's now based off a smaller and smaller balance every year after that fixed rate period is over. But the number one and most important advantage of the hybrid arm is that it allows you the opportunity for cash flow. It allows you to apply the money that you save towards higher interest rate debt, which can result in much greater overall savings. After all, think about it. At the end of the day, what matters most to you? It's not what's my mortgage payment going to be. It's how much is coming in each month and how much is going out. If you have the opportunity for 3 or 5 years to save so much money that you're able to pay off a credit card or a second mortgage or a car loan or some other kind of debt that you wouldn't ordinarily be able to pay off keeping a fixed rate mortgage or pay off as quickly I think if you look at the numbers, you'll see that it's to your major advantage to pay off higher interest rate debt as soon as possible. The sooner you do that, you free up that money. So even in the event that your rate was to go up, your overall expenses are far lower than you could ever get keeping a fixed rate mortgage and keeping that debt as well. An extra $250 would allow me to pay off those credit cards in a year. Those cost me $600 a month. I must admit I'm intrigued, but where can I find out more? Well guys, I got an answer for you. Want to find out if the VA hybrid can help you? Well, to discuss a scenario based on your data, or just to clarify any questions you may have about VA loans, the VA hybrid, or anything else for that matter, please call the VA loan team at Flagship Financial Group toll-free at 877-MY-VA-HUB, or shoot us an email at jshergill@ffgpartners.com. As a specialist in VA loans, Flagship Financial Group has earned wide acclaim, including an A+ rating from the Better Business Bureau with loan consultants who annually rank first in the nation for VA loan origination. Until next time, this is James Shergill for VALoanRater.com, proudly serving your peace of mind.